Hi, how are you? Okay, folks, let's get settled in. Sorry about the flurry of emails today. I know the last one that I sent was at 1 o'clock, and most of you probably didn't even get it. It had this list. Doesn't matter though. You're here. You got the list, so you can work with me on this. I want to start off today by going back to that slide I left you with on Monday. We talked about bias being the biggest enemy of valuation, and you might have felt I was indulging a little bit of hyperbole, which I sometimes do. So I want to start off today by kind of getting your sense of where the bias is going to be, or which direction the bias is going to be, on a variety of different valuation scenarios. Okay. So this doesn't require any technical knowledge. What I want you to do is put yourself in the mindset of that appraiser and ask yourself, given what I've been asked to do, am I going to come up with a high number, a low number, or you might say, I don't know. Okay, so let's see. Let's start with the first item on the list. You own your own business. You're valuing your business for sale to somebody else. Bias is going to be high number, right? Unless you have some self-destructive impulse that leads you to kind of, I want. You're a venture capitalist valuing that same business to take an equity stake in that business. Why? What's the advantage of coming up with a low number? How does it show up in the deal? Yeah.
Sell later, the returns will be...
No, but forget even selling later. You're taking the position right now. In return for the position, what are you going to demand? A share of the company, right? The lower the number you attach to the company, the bigger the share of the company the owner has to give up for the same amount of money. And you know how it manifests itself in venture capital valuations? How do venture capitalists value companies? Very badly, I know, but how do they do it? What's a traditional venture capital approach to valuation? No, but Ray, but the actual approach is actually very, very clearly set. They project the earnings out 3 years from now.
50%, 70%.
They have it. So the first thing they do is they project the earnings out 3 years. They apply a multiple to that number, and then they discount that number back to today using what they call a target rate of return. If you've ever seen venture capitalist target rates of return, you know what the numbers look like? 35, 40, 50, 55, 60, 70%. Think of the consequences. You discount that number from 3 years forward back at 70%, you're going to end up with this tiny value for the company. You're going to go to the owner and say, I'm going to give you 100,000, I want the whole company. The owner, of course, tries to bargain with you. So you can already see that the bias in venture capital valuations is going to be to try to push the number down, using a lower multiple, applying a higher target rate of return. Which also means that you should never read too much into a venture capitalist target rate of return. I've actually had people say, well, what beta would I need to do to get up? This is not a target rate of return. This is a made-up rate of return. There is no reason for that number other than they want to push the number down today so they can get a higher share of the company today. Okay? You're valuing your own business for divorce court. Your spouse will get half your business, the soon-to-be ex-spouse. So what's your estimate of the value of your business? What are you going to claim? Oh, it's worth nothing. Half of 0 is 0. Take 0, right? You're an appraiser for the owner valuing the business for tax purposes. In other words, the IRS is going to charge you a tax based on an estate tax based on the value of your business. So what's your job as the appraiser? Come in the low value or a high value? Amazing number of private company valuations are either for tax court or divorce court. And guess how it manifests itself in private company valuations? After the valuation, you know what private company appraisers do? They discount the value for liquidity, for control, for private. Basically, they go crazy because they want to knock the number down. They come up with, let's knock 20% for this, 30% for that, 50% for that. And before you're done, the business is worth nothing. But if you're the appraiser working for the IRS valuing the same business, guess what? You want to come up with a high number. In fact, about 2 years ago, I was at a conference of of utility regulatory analysts. Their job actually, can you imagine how exciting this must be? Is to come up with regulatory rates for utilities so they can get a price increase. The way regulated utilities work is they have to go to the regulatory commission and say, we need to make an 8% return, this is the price we need to charge. So that rate of return is a big issue for utilities, because the higher that rate of return you can come up with, the more you can increase prices. So I go to this meeting, and my job is to talk about equity risk premiums. So I said, before I talk about equity risk premiums, I'd like a show of hands. I said, how many of you work for the utility companies? And about half the group put up their hands. They're all congregated on one side of the room. I said, how many of you work for the regulatory commissions? The other half of the room put up their hands. And they were together in the other group. Then I said, let me make a guess. One of you uses really high equity risk premiums, the other uses really low equity risk premiums. You can probably help me. Which group do you think uses really high equity risk premiums? What did I say that required return is used to do? It's to set prices. The higher the number you can come up with, the more you can raise prices as a utility company. The half of the group that worked for the utility companies were using equity risk premiums of 7%, 8%, 9%, backed up, of course, with their own statistics. The half of the group that worked for the regulatory authorities were using equity risk premiums of 4%, 5%, backed up by their own set of numbers. But you can almost call this before you even looked at the numbers. Bias gives away the process. Let's move up. You're a sell-side equity research analyst valuing a company with the intent of putting a buy or a sell recommendation on it. High, low, or uncertain. Why though? The job description basically looks like you should be pretty neutral, right? Why is there a tendency to go high rather than low? It actually is an empirical fact. Equity research analysts tend to overshoot rather than undershoot. What is it about equity to sell-side equity research that you think creates a buy?
They have colleagues working for investment banking.
Or they might even be worse. Forget about colleagues. They might actually be getting investment banking business because of the company, which is the Jack Grubman effect. Jack Grubman actually made this famous in the 1990s because he boasted that when he was equity research analyst at Solomon, he brought in $250 million of investment banking business every year into the company. That's a bias. But even if you took that out, there's another factor.
I'd say they want to please management because for them to be successful, it's key to have a good relationship with management.
Right? They follow 12 companies. This is the rest of your life. These are the 12 companies you're going to be dealing with the rest of your life. You put one sell recommendation. Guess what? The next time you pick up the phone, you call the company, you're completely cut off. If this is a game about maintaining contacts with companies, the one word you can never use in an equity research report is sell. That's why you come up with weaselly things like we've lowered this company from a strong buy to a semi-strong buy. Okay, I get the signal. You don't want to say sell, so you're going to have, or what's even worse is companies that use numerical systems. We lowered the company from a 7 to a 6. What the heck is a 7 and what the heck is a 6? But the fact that it moved from a 7 to a 6 is a bad signal. Built into the sell-side equity research report is at least some bias, and at least in the 90s that bias got worse, to pushing values up. You're an M&A analyst working for an investment banker for the acquirer in a friendly takeover valuing the target company. High, low. Really? You have come up with a low value, and the company pays a price higher than that value. They're in trouble, right? So if you're the acquirer, you want to back up whatever price you pay with the value. Say, hey, I got a good deal, look. I'm sure there are people at Pfizer saying, look, we have a valuation of what? It's $20 above what we're paying. That's the only way you can go to your stockholders and justify that acquisition. So when you're an M&A analyst working for the investment banker and you're valuing the target company, it's a friendly merger. Your valuation, and in fact, the joke I make, and this is not even that much of a joke, is I think it's a waste of time and a waste of money actually valuing a target company in an acquisition. You know the value of a target company in an acquisition is? It's whatever you decide to pay plus $10. Why go through the charade of having numbers and models to back into that number? Because that's where you end up. And you know what? The place it's most visible is when the acquirer keeps raising the price and the investment banker keeps chasing that price. So it started at 55, the investment banker will give a value of 65. The acquirer raises the price to 70, magically the value will go from 65 to 85 or 90. So in a sense, the value kind of keeps up with the price just to justify whatever's paid. What if the M&A analyst working for the investment banker for the target in a friendly takeover? This target management has to go to the stockholders and convince them what? That they're getting a good deal, right? So at one side you say, hey, you know what, that must mean that you have to show the price is equal to value, or better still, that they're overpaying for the company. So at least there's some tension created here. The only problem though is, if you're not careful, the deal could fall through. So you don't want to do anything that will mess up the deal, because the deal falls through, why do you care? You're the investment banker. You get money only if the deal goes through, right? So there's this built-in process here. Whatever number you come up with, you better make sure it's not a number that might cause the deal to fall through. Okay. What if you're a M&A analyst working for the investment banker for the acquirer in a hostile takeover? Again, it's the same impetus, right? You want to convince the stockholders of the company that you are paying them. But in this case, you got to be showing them the price is in fact close to the value. Otherwise, they're going to say, hey, that's too little. So you have actually a mixed effect. One is to your own stockholders, you got to show them one number, saying we're getting a good deal. To the target company stockholders, you got to show the same numbers. No, 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 this is actually a very good deal for you. It's like, it actually can't be a good deal for both sides, right? You're either paying too much or you're paying too little. But again, I'm not surprised often when I see two numbers from the same investment banker, one floating around among target stockholder circles and one floating around acquiring stockholder circles. Question?
Yeah, so wouldn't it be different if we were actually doing the valuation for negotiation purposes?
Let's dispense with that, because if you're crunching numbers as a bargaining chip, it's a waste of time. Because it's a bargaining chip, right? You know, you want to start high, they want to start low. Why are we doing a valuation? It cuts into the integrity. I mean, if you're going to use that, just do it. Just throw a high number out, throw a low number out, end up in the, it's like the legal system. You know how the legal system works, right? You come up with 40, I come up with 80, guess what the court goes? Right down the middle. And once I recognize this, you put up 40, I'm going to put up 100, because then I get a higher. It's a system that internally is going to kind of, valuations are not going to matter anymore. So never ever think about valuation as a bargaining chip. That's a number that you're going to use for bargaining. Because bargaining, they put a low number, you put a high number. Valuation is about knowing what the value of the company is. So once you know the value of a company, then you can bargain around it. But don't let the valuation go up and down to justify a bargaining number. I'll let you work through the rest, but in particular, the last two, even when I go and talk to buy-side analysts, they're always a little protective of themselves. They say, look, we're not like sell-side analysts. There's no bias here. The only problem is, if you're a you know what a buy-side analyst is? You're an analyst working at Fidelity. And you basically work for the company, for the portfolio manager, so that we don't have the kind of biases that a sell-side analyst does. It's true, they don't have the same kind of biases, but they have a different set of biases. That's why I threw in the last two. If Fidelity Magellan owns 1 million shares of a stock and you're the analyst valuing the stock, you're going to think hard and long before you say, hey, you know what? The stock is overvalued. Because that portfolio manager is going to freak out at you. He's going to say, look, we already have 1 million shares. You just put out a statement that it's overvalued. So it's even on the buy side, it can make a difference, because the positions you come into, and this is true in hedge funds and in portfolio managers, can affect the kind of valuations you see for them. Okay. I haven't even talked about mark-to-market valuations. And you can figure out already the kind of biases that are going to creep into mark-to-market valuations, which are accounting valuations. They're show valuations. They're not transaction valuations, but they can affect a lot of different things. Okay. Yes, question?
My question was around the legality of showing one set of figures to the target and another set of figures to the acquirer.
You know how they cover themselves? Is they provide a range. I've actually had an investment banker say, I never value a company, I provide a range on the valuation. That's a cover. It says, they say, look, there's so much uncertainty in the numbers. So if the risk premium changes, this is the number. If the risk premium doesn't change, this is the number. So in a sense, it's not even that there are two numbers. By having a range, they're able to kind of eat their cake and have it too. Okay? That's why I think often a range exists and all these what-if analyses are done primarily so that they can kind of straddle both sides here and walk away with whatever their advisory fees are, no matter which number works out. So I think it's legally they can protect themselves by providing ranges, doing Monte Carlo simulations, doing all that neat stuff. But there are ways around it. Any other questions? So let's put it up and go back to this slide. One final point on this slide. Remember I ended the last session talking about complex models and how complex models can end up being black boxes and lead to input fatigue. We just make up the numbers. Here's another reason this is the valuation intro, the packet. Right? Here's the other reason I'm a little suspicious of complex models. You can mangle some simple assets by trying to use complex models. Hey, let me take you through my favorite example. Cash. Every company has a cash balance, right? Some have huge cash balances, 15 billion, 20 billion, 25 billion. Every week, I get at least a half a dozen emails from people I don't know. I get more than half a dozen from people I don't know, but half a dozen from people I don't know on a specific topic. Here's how the emails will go. Professor Deodorant. It's amazing what Microsoft Word will do to your name with spell check, right? So, okay, good, I can live with that, right? I have spent the last 6 months of my life building this model to value cash. To which my first response is, you must have a pretty empty life. What the heck are you doing? Huh? Could you please take a look at the attached Excel spreadsheet that I've built to value cash? And at the bottom there'll be cashvaluation.xls. I don't even open these spreadsheets. I mean, who knows what viruses lurk in there? I've actually programmed the F7 key on my laptop to respond to these emails. I hit the F7 key and you know what it says? Have you tried counting it? It works with cash. $20, $40, $60. You don't need a model to value cash because you know what happens when people build models to value cash? They go looking for trouble. Let's take an example. Let's take Intel. $12 billion in cash on its balance sheet, right? So you decide to value cash because you've got an MBA, you've got to try all those tools out. So first thing you're taught to do is project income from the cash. That's easy. Let's suppose, right now if you see cash and marketable securities on the balance sheet of a company, where is it usually invested? Hopefully not auction rate securities. So let's hope that it's actually invested in something close to cash. Treasuries, commercial paper, making at the moment how much? If you're lucky, maybe 2%, 3%, right? So you got $12 billion invested close to risklessly earning 3%. So you sit down, you project the income from the cash, 3% of 12 billion every year for the next 10 years. The minute you project the income, all is lost. Because then the Pavlovian response kicks in. You know what I'm talking about? During 2 years of business school, we kind of imprint this on you. You project numbers out, you have to discount them, right? To discount the numbers, you need a discount rate. And you haven't spent, what's the cost of an MBA right now? $150,000, something like that? For nothing, so you start pulling all your tools and models, like CAPM, arbitrage pricing model, multi-factor model, you plug and you chug and you come up with a cost of capital of 10%. You pat yourself heartily on the back. Got it, huh? I remember my corporate finance. Then you start discounting the income from the cash at 10%. So let's see what we have. You have $12 billion in cash invested close to risklessly earning 3% a year. You discount that income back at 10%. What do you think is going to happen to 12 billion in cash? It's going to become 10 billion. You want to make it 8 billion? Try it 15%. You want to show me cash is worthless? Try 50%. It's amazing how quickly you can burn through billions without even seeing the money. You're saying, this is absurd. No analyst would do it. If you see an equity valuation model where people start with net income, a lot of equity valuation models, you start with net income and work to cash flows. Think of what you're doing. Net income includes earnings from operating assets. It also includes the earnings from cash, right? It's all in that net income. If that is your basis for estimating cash flows, part of your cash flows are cash flows from a riskless investment, and you're discounting that back at your cost of equity. You've just done exactly what I described. You just didn't realize it because it was embedded in all those other cash flows. In the physical sciences, there's a principle called the principle of parsimony. The principle of parsimony basically says, when you're trying to explain a phenomenon, start with the simplest possible explanation for it before you make yourself Einstein. We should adopt the same principle when it comes to valuation. When you're trying to value an asset, ask yourself, what's the simplest model I can use to value this asset? If you can value an asset with one input, don't go looking for 3. If you can value it 3, don't go looking for 5. If you can value a company with 3 years of forecast, you don't have to do 10. There is no law that says you have to do a 10-year forecast. You think, what's the cost? As you add detail to the valuation, guess who has to estimate those inputs? You do. Don't add layers of inputs when you don't need them. Okay? It's a principle we will return to again and again, because when I value the companies, and this is going to be way down after the 10th session, I'm going to take 15 companies. With every company, I'm going to start off with a question. What's the simplest model I can get away with valuing this company? If I can value that company with a stable growth, dividend discount model, I'm not going to be doing a 10-year free cash flow to the firm model when I don't need it. So rather than have one model to value every company, start thinking from the company outwards. What can I get away with? And actually that works nicely for me. I'm a lazy person. This kind of feeds into the laziness, saying, hey, less is more. But adopted in valuation, trying to build complex models to value simple assets will generally mangle those assets. Okay? So with that in the background, let's set the table. There are 3 basic approaches to valuation. The first is discounted cash flow valuation. Discounted cash flow valuation, the value of an asset, is the present value of the expected cash flows in the asset. Okay? The second is relative valuation. The value of an asset is based on how similar assets are priced out there. Multiples and comparables. And the third approach is a contingent claim valuation, where basically you value an asset based on some contingency occurring in the cash flows as a result, which is really which is option pricing applied in the context of valuation. Every valuation model out there is going to fall into one of these 3 buckets. You say, what about liquidation valuation? What's liquidation valuation? How do most people do liquidation valuation? They take the balance sheet and then they take the assets in the balance sheet, and what do? Well, but they also figure out what they will get if they sell the assets, right? To which my question is going to be, how do you come up with that number? There are 2 ways of coming up with that number. You can do a discounted cash flow valuation of the assets, or you can do a relative valuation, see what you'd get if you sold those assets. Or you can trust the accountant. I'll just use book value as liquidation value. My point is, liquidation valuation is not a valuation approach, it's a valuation technique, where you're using one of the approaches and trying to estimate what you would get if you liquidated the company today. I think one of the problems in valuation is we tend to allow for a proliferation of models. We think of 16 different ways. You think you're actually making your life easier because you have all these choices. You're actually making your life more difficult, because if you think of them as competing models, you're going to get 16 values for your company, and then what are you going to do next? So let's start with the basis for all of these approaches. How many, most of you have taken what, 3, 4, 5, 6 finance? What's the requirement to actually have a finance major now? 5 classes at least? What, 9? Just 3 and they give you a finance major? We have to redo this whole thing. This isn't. But you've taken at least 3, right? That's a minimum. Most of you have taken more than 3. Somewhere along the way no? Doesn't matter. Even if you took 1. Even if you took 1, you've got your indoctrination already started, right? There's some talk about efficient markets in that class. It's almost a belief system that got into play. So one of the things that usually comes up when people come into this class is, you might not have asked me yet, but I get asked, do you believe in efficient markets? Don't ask me, do you believe in efficient markets? No, you're not going to ask me? Okay, I'll act like you're asking me. Do you believe in efficient markets? If I believed in efficient markets, would I be teaching this class? If I truly believed in efficient market, what's the value of Intel? Just open up the Wall Street Journal, look it up. If I were truly a believer in efficient markets, valuation is going to last all of 15 minutes. That's right. Look up, basically I rotate alphabetically, go across, last column, you're done. So embedded in the process of valuation must be a belief that markets make mistakes. Right? I mean, that's built in. So the question is, what kind of mistake do markets have to make for each of these 3 approaches to work? In fact, I'm going to argue that one of the factors that's going to determine whether you use discounted cash flow valuation or relative valuation is your belief about how markets work and how markets fail to work. Let me illustrate my point. Let's start with discounted cash flow valuation. Discounted cash flow valuation, as I said, the value of an asset is the present value of the expected cash flows in the asset. You know what we're trying to do in discounted cash flow valuation? We're trying to estimate the intrinsic value of a business or an asset. You know how many discussions I've actually had with equity research analysts, debates where analysts who claim that there is no such thing as intrinsic value. I firmly believe, and this might be just my belief, that every asset has an intrinsic value. I also firmly believe that none of us will ever get to see it. So in discounted cash flow valuation, it's a little bit like searching for the Holy Grail. You keep looking, and you keep looking, and you keep looking. You know you'll never find it, but the fun is in the looking. In contrast, in relative valuation, you kind of given up, right? You say, I don't know what the intrinsic value of something is. Let me see what other people pay for this. It's a very different philosophical view of the world. But in discounted cash flow valuation, you kind of hold on to that thought. And if you break down discounted cash flow valuation models no matter how complex they get, every discounted cash flow model has three ingredients. It's got cash flows, obviously. It's got a discount rate, obviously. And it has a life for the asset, right? You give me those three inputs, I should be able to value any asset. This is not about valuing individual companies, stocks. This is basically a technique you can adopt for any asset that has cash flows, and we can estimate a discount rate based on the cash flows. But let's cut to the chase. Think of why we do discounted cash flow valuation. I don't know about you, but I don't lie awake at night curious about what Google is worth. Frankly, I don't waste my time worrying about, I have no intellectual curiosity about what Google is worth. So why do I value Google? What is it I hope to do? I'm greedy. I want to make some money off this, right? So let's think about the pieces that have to come into play for you to actually make money on your discounted cash flow valuations. First, we have to assume that markets make mistakes, right? A reasonable assumption? I don't think you'll find a single person in the world who will disagree with that assumption. Even the firmest believer in efficient markets will concede to you that markets make mistakes. That's an easy one. Second, you have to assume that you can find those mistakes with your metrics and models. Now we're on dangerous ground. Because the track record of people who claim to find market mistakes is not that good. This is where people who believe in efficient markets separate from people who don't, right? People who believe in efficient markets say markets make mistakes, but they're random. You won't know which direction they are until you buy the stock. But in this case, you have to assume that you can find those mistakes with your metrics and models. Let's make this less abstract. Let's pick a stock. Cisco. What's Cisco trading at right now? 17, 18, somewhere around that? Let's say it's 17. You value Cisco and you come up with $35 per share. Let's say you're right. That Cisco should really be trading at 35. The value is 35, it's trading at 17. You decide to act on it. You go buy 1 million shares of Cisco at $17. So you found a market mistake with your model, right? What's the third link that has to come into play for you to actually make money? That $17 has to go to 35. You know what? Before you jump on somebody who believes in market efficiency, think about it. We all believe in market efficiency. The only question is when we think markets become efficient. Somebody who believes that markets are efficient thinks they're already efficient. You and I think that markets are inefficient until we take that really big position in the stock, and then they magically become efficient and deliver returns to us. If markets were completely random, you know what? You could buy it at 17, you could go to 6. So we're all believers in market efficiency in the long term. We just don't think it applies right now on this stock with our investment. So here are the three links you need. Markets have to make mistakes. You have to find those mistakes. Markets have to correct their mistakes. The first two links you might control, right? But how do you make sure the market corrects its mistakes? You could get on one of those chat rooms and try to talk the stock up. But you're dealing with a lot of rabble. They're talking different things. So, no. Yeah.
In the long term, aren't you going to get the cash flows?
You could sit and wait for the cash flows. But the cash flows, if the price never adjusts, it'll take a long time before the cash flows deliver enough money for you, right? So in a sense, unless you're willing to say, look, I'll settle for the cash flow yield every year and I don't have to make it, there's this implicit belief, even among value investors, that the cash flows alone won't do it, that the price eventually will adjust to the value. Okay? You do have that fallback of cash flows. It's not a complete loss. So if you buy Dow Chemicals now, you can say, look, I get a pretty big dividend, so it's okay. But you want that price to adjust. It's what makes, I think, investing so frustrating. You can do everything right and go bankrupt. You can do everything wrong and make millions. There's no justice in this world. The only consolation price I can give you is the longer your time horizon, and that's where the cash flows kick in, the greater the chance that the market will correct its mistakes. Even though I can't guarantee the market correction will happen, the longer the time horizon, the greater the chance markets will. I've already given away a secret as to whether you should use discounted cash flow valuation or relative valuation, right? You're saying, how long is long term? I'm thinking 3 years, 5 years, 10 years. If your time horizon is 6 months, my advice to you is don't waste your time doing discounted cash flow valuation, not because you can't value the company, but because you're not giving the market enough time to correct its mistakes. If your time horizon is 5 years or 10 years, you're a much better candidate for discounted cash flow valuation. There's one group of investors, though, that might be able to take the third link and have an influence on it. What are the Carl Icahns on what do activist investors in general try to do? They find a stock where they think the market's made a mistake. They take a big position in the stock, and then they try to change the price. And because they're large enough investors with a reputation, they might be able to, in a sense, affect that third leg. That's a big advantage. It's nice to be able to move stocks. It's an advantage that Warren Buffett has that you and I will never have. All he has to do is say, I bought the stock and the stock shoots up. You try that. I bought the stock and the stock goes down. Right? It goes in the opposite direction. So the embedded assumptions about market efficiency will often determine whether you go to discounted cash flow valuation or relative valuation. So let's think about the good side of discounted cash flow valuation. You look at any valuation book, it's almost like it's the only way to go, right? And there are some advantages. Discounted cash flow valuation forces you to think about the insides of a business, done right. I mean, a lot of discounted cash flow valuations are surface numbers, but if you do it right, it forces you to think about the fundamentals of a business. What kind of returns it makes, how risky it is. And if you buy into the Warren Buffett adage that you should buy businesses, not stocks. He's always said, look, I never buy a stock, I buy the underlying business. Then in a sense, you're really a candidate for discounted cash flow valuation. I know what you're saying, but Warren Buffett says he never does discounted cash flow valuation. Don't believe everything he says. He does his own version of discounted cash flow valuation. I know he doesn't adjust for risk, but instead of adjusting the discount rate for risk, he uses what I call certainty equivalent cash flows. In other words, he counts only those cash flows that he believes he can count on, which is another way of adjusting for risk, right? You've lowered the cash flow. He does his own version of discounted cash flow valuation. In fact, this is a message that I think is worth repeating. You don't have to actually do a model to buy into an intrinsic valuation world. If you think about the world in terms of fundamentals and cash flows, you're in a sense an intrinsic value person, not a relative valuation person. So the biggest advantage of discounted cash flow valuation forces you to understand the business. It also insulates you against market perception, right? Because in a sense, if you do this right, you're going to value your company, and what the rest of the world is doing is kind of noise on the side. I'm not saying it's not going to influence your valuation, but it's noise. Which means that everybody else is panicking and selling a stock, your discounted cash flow valuation will still keep you in there. If everybody else is panicking and buying the stock, it'll do the same thing. So it keeps you a little steady in a market where everybody is kind of changing their minds. So that's the advantage. Here's the disadvantage. Whatever you saw as pluses for discounted cash flow valuation are going to become minuses at some point. Let's take the first point. It insulates you against market perception, right? But what if your job is to estimate what you can sell a stock for today to the market? You're valuing an IPO. You're valuing an acquisition. Your job is not to tell the acquirer what the intrinsic value of what they're buying is, but what they can get if they sold the business today or bought the business today. You can already see that your job description is going to play a big role in whether you go with discounted or relative valuation. In IPO valuation and acquisition valuation, multiples are going to rule the roost, because your job is not to make some intrinsic value judgment to say, hey, this is what you're buying, this is what you have to pay to buy it. The minus of having to look at the insides of the company is it's going to be a lot more time intensive and resource intensive to do a discounted cash flow valuation than a relative valuation. Often portfolio managers don't even try to do discounted cash flow valuation, because if your universe is 1,000 stocks and you got to pick among them, you can't do intrinsic valuation with 1,000 stocks. It's much easier to use multiples and comparables to make that judgment. And here's a final point, and this is something we tend to forget. With discounted cash flow valuation, you can value 100 stocks and you can find every one of them to be undervalued. You can value 100 stocks and you can find them, every one of them to be overvalued. That can never happen with relative valuation, right? Why? Because by its very definition, if I'm comparing stocks to each other, half of stocks are going to come out as undervalued, half are going to come out as overvalued. You think, so what? Let's say you're an equity mutual fund manager. Your job is to be invested 100% in stocks, right? You decide to use discounted cash flow valuation and everything looks expensive. It's the end of 99. If you were honest with yourself and you stuck with this intrinsic value view of the world, what should you do? You should liquidate your fund and return the money to the investor saying, sorry, I could not find anything to buy. Now, if you work for Fidelity, try doing that. So you liquidate a fund, go to your boss and say, you know what, I couldn't find anything to buy, I just decided to liquidate the fund. He'll liquidate you. But you know, part of Warren Buffett's reputation comes from something he did in the late 60s, which is precisely what I just described. Buffett started managing other people's money in the late 50s. And I think in 69, stocks had zoomed up. It's not my phone, right? Hey, stocks had zoomed up. You know, it was the Nifty 50. I mean, you had stocks like Polaroid and Eastman Kodak. And in a famous letter, and you can actually look this up online, it's also on my website, I think. He wrote a letter, Warren Buffett wrote a letter to his investors saying, at this point in time, I have two choices. I can stick with my valuation philosophy, which effectively means I can find nothing to buy and return the cash, or I can bend my philosophy and find something to buy because you've given me the money. He said, I'm not going to do the latter. Here's your money back. That made his reputation, because very few portfolio managers, even if they're doing this on their own, are willing to do it, because you're giving away a hefty fee right there, right? Because you're making 1% of that money. Think of returning $1 billion back to investors saying, I couldn't find anything to buy. So if you're an equity mutual fund manager, you can already see that if you use discounted cash flow valuation, you might very quickly find that there's nothing to buy or that everything looks cheap. It cuts against what you want to do as an investor. It's one of the advantages that hedge funds have over mutual funds, right? Mutual funds are constrained to be long only. Hedge funds can go long and short. So in a sense, if you're doing intrinsic valuation and you're a long-term hedge fund, you can play both sides. It does give you an advantage over a typical mutual fund which can go long only and therefore can't play both sides of the valuation. So those are the disadvantage of DCF valuation. So you can see the plus and minus. It's not a slam dunk. So what kinds of companies are DCF valuations best suited for? Well, clearly, you've got to have some kind of cash flows coming out of this asset. You asked me to value a Mickey Mantle rookie card. There's no way I can use a discounted cash flow model. There are no cash flows coming. You asked me what the value of gold is. I don't know. There's no obvious cash flow. It's a commodity. So you've got to have cash flows. You've got to be able to assess the risk of those cash flows to come up with a discount rate. But those cash flows could be way out in the future. Right? So generally speaking, if you think about applying discounted cash flow valuation, make sure that there are underlying cash flows to discount, that you still have to estimate those cash flows, adjust for risk, but that's a minimal requirement. As investors, if you're going to use discounted cash flow valuation, make sure you have a long time horizon. We talked about why. To give the market time to correct its mistakes. And if you can provide that catalyst, which is what activist investors do, of making the market fix its own mistakes, that's an advantage. You're a much better candidate for intrinsic valuation if you're an activist investor than if you're a passive investor, because your odds improve. Any questions? Obviously, we'll come back and talk about the details, but philosophically, that's where discounted cash flow valuation comes from. What about relative valuation? Relative valuation, you've kind of given up. In relative valuation, you value an asset based on how similar assets are priced out there. You're basically saying there's no such thing as intrinsic value. I'm going to let the market tell me what something is worth. In a sense, you're a much bigger believer in market efficiency when you use relative valuation than you do discounted cash flow valuation, right? You see why? When you use relative valuation, what are you assuming? On average, the market must be pricing chemical stocks right, steel companies right. On this particular stock, it might have screwed up, but on average, it's getting it right. So the belief you have about market mistakes is different from discounted cash flow valuation. Discounted cash flow valuation, you assume markets make mistakes and correct them over time. In relative valuation, you assume that markets are right on average, but get individual assets wrong. And if you break a relative valuation down, there are three ingredients. First, you've got to come up with a group of assets that are very similar to the one that you're valuing, right? Are there houses that look just like yours? Are there Mickey Mantle rookie cards that are just like yours? Second, you've got to scale that price to something. Not necessarily with a real asset, but if I came to you with a stock, and you'd looked at market cap has to be scaled to something, to earnings, to book. A multiple is just a standardized price, right? Basically, it allows you to compare large companies to small companies and get away with it. And then if you're careful, you've got to control for difference. You might say, what differences? Well, you might be lucky and find exactly identical assets, but don't go searching. Especially if you're valuing stocks, I will guarantee you up front that you will never find a company exactly like yours. So you got to come up with some way of adjusting for differences on growth, on risk across these companies. A lot of what we're going to talk about in relative valuation is going to be about adjusting for those differences. Let's think about the advantages of relative valuation. Right? In effect, it flips whatever you saw in discounted cash. The disadvantage of discounted cash flow valuation become the advantage of relative valuation. It's going to reflect the market mood, and here it's a good thing, because that's your job. If you're valuing an IPO, valuing an acquisition, you want your price to reflect the market mood. Relative valuation is more likely to do this. Okay. As we said before, discounted cash flow valuation, there's no guarantee that you're going to get any percentage of stocks being undervalued or overvalued. The relative valuation is going to be roughly 50-50. Right? Because of the nature of the process. And especially if you're a portfolio manager, the reason relative valuation works so nicely for you is the way you get judged is on a relative basis. Do you see what I mean by that? Go and look at Morningstar's rankings of mutual funds from last year. How do they rank them? Not whether they made money, but on how little they lost relative. So you're a growth mutual fund manager, you say you lost only 18%, you're wonderful. Because you get judged on a relative basis, you can already see that if you're a portfolio manager, there's a much bigger payoff using a relative valuation as opposed to intrinsic valuation. So those are all factors, I think, that drive the use of relative valuation. And maybe you can start thinking about, maybe these are the reasons why 80% of all valuations are relative valuation. You have a short time horizon, you get judged on a relative basis, you can already see that this feeds much more into your job mission than trying to do an intrinsic valuation. The disadvantage of relative valuation, as I said, your strong points become your weak points, is you reflect the market mood. So the market's over optimistic. So at the end of 99, you'd have said .com stocks all look fine. Relative to each other, they all look fine. Right now, bank stocks all look fine because relative to each other, they all should be trading at 70% of book value. So the nature of relative valuation is you are not making a judgment about whether a stock is cheap or expensive. You're making a judgment on whether something is cheap or expensive relative to what you compared it to. Keep that in mind. The next time you see an equity research report and you see a buy recommendation, what's the equity research analyst saying? Is that stock is cheap? No, all he's saying is, given these 11 stocks that I cover, this stock looks cheap relative to the other 10. All equity research reports are relative valuation judgments, which means you can buy that stock and actually lose money, and the equity research analyst could still be wrong because you lost less money than everybody else in the sector. It's a relative statement. So we already talked about the market efficiency argument that's built in. Markets are right on average. If that's not true, your entire relative valuation is going to collapse. There's one final point that's made as a plus for relative valuation that I don't quite buy into. A lot of equity research analysts that I talk to tell me that relative valuation requires fewer inputs than discounted cash flow valuation. And it's on the surface, that seems to be true, right? But here's why I think that's not true. In discounted cash flow valuation, your assumptions all have to be explicit. Risk, cash flows. I force you to unearth your assumptions. In relative valuations, you make exactly the same assumptions. You just make them implicitly. It's behind the surface. In fact, one of the things we're going to do when we talk about relative valuation is we're going to take each multiple and look behind and say, these are the assumptions. When you use 22 times earnings, these are the implicit assumptions you're making about growth, risk, and cash flows. But at least on the surface, relative valuation looks a lot simpler, fewer inputs than discounted cash flow. But if you look below the surface, those assumptions still have to be made. So let's bring it all together. If you're going to do relative valuation, it works best if you have a lot of other assets that look just like yours. That's why with real assets, relative valuation works so well. If you have a Tiffany's lamp that you want to sell, a ticket to Yankee opening day you want to sell, I can estimate it because there are dozens of other assets out there that look just like your assets. So it works better with real assets than with financial assets. Those assets have to be priced. It's actually one of the big problems in real estate, because in real estate, people do relative valuation, but they have to base it on transaction prices. And because there are relatively few transactions, so if you have a Fifth Avenue building, you don't have Fifth Avenue buildings trading every day. You have transactions spread across time. You don't have as many transactions. The prices on some of these are going to be stale. They're going to be from July, and they're not relevant anymore. So if you can get a price, and the price is recent as opposed to old, relative valuation works much better. And thirdly, there's got to be something you scale that price to. With real estate, what do people scale prices to? Square feet, the number of bedrooms. So basically, you have to scale it to something. Okay? And for what kinds of investors does relative valuation? If you have a short time horizon, 3 months, 6 months, 9 months, I think you're a better candidate for relative valuation. If your job requires you to be invested in equities no matter what, relative valuation is better for you. And if you get judged on a relative basis, even better. I'll make a prediction. I have a bias towards intrinsic valuation, and it's going to come through over the next 14 weeks. And I might contaminate some of your belief systems with my belief in intrinsic valuation. At the end of this class, I'm going to ask you whether you believe in intrinsic valuation. Many of you might say yes. In fact, I'm going to put this question up. Right now, if I ask you to pick, you might say, I don't know. But at the end of this class, I will have brainwashed some of you enough that you're going to say I'm an intrinsic valuation person. But here's why I never worry about it. Because you're going to go out there and you will have a job description that will push you away from intrinsic valuation for the rest of your life. This is the most intense intrinsic valuation immersion you're going to get. So the way I see it, the rest of the world is going to give you the other side of the picture. My job is to at least give you this side of the picture, because the nature of most valuation jobs is it's going to push you towards relative valuation. So I don't blame equity research analysts for using multiples and comparables, because that's what their job description pushes them to. I don't blame appraisers for using relative, because that's what their job description pushes them to. It's the nature of the process. When we talk about relative valuation, we'll come back and address some of the problems. Okay. So think about this. For the moment, as I said, it's going to be kind of, you haven't made up your mind yet, but think about it, because through this entire 14 weeks, you're going to go back and forth between these two approaches. I'm not saying one is good, the other is bad. There's just two different ways of thinking about markets, thinking about the world, thinking about what's going to happen. And you got to make your own judgments based on your belief system as what's right for you. What works for me might not work for you. Yeah?
The problem with relative valuation I see is basically that you're looking at all assets to be, like for example, if you had Toyota, Ford, and General Motors, you'd always say Toyota is overvalued and overpriced.
That's not true. That's not true. We'll come back to that. It's not that simplistic. If you do relative valuation right, it depends on what you scale it to. And it doesn't automatically follow that. In fact, I would show you at least a couple of multiples where Ford and GM look cheaper than Toyota. Here's an example. You might not have seen this multiple. Multiples of market value to replacement cost. It's a big new multiple that's been created in sectors like automobiles where nobody makes money and you don't trust their earnings anyway. So what they do is they've come up with the cost of replacing the assets, these companies, from scratch. And on that basis, Ford looks incredibly cheap, because if you try to create what Ford has as assets from the ground up, it'll cost you trillions of dollars, or maybe not trillions, hundreds of billions of dollars. You say, hey, the stock looks cheap. So it depends again on what you scale it to, which I think is another problem, is you can get 3 stocks and how you rank them can vary dramatically depending on what you scale it to and what your mission is. So we'll come back and talk about relative valuation. It has its faults, but some of those faults at least you can put a stop on if you're a little more careful about how you structure it. Yes?
Does it make a difference in terms of what kind of company it is, like in terms of whether it's a stable company versus a growth company?
In terms of what? Okay, let me dig a little deeper. Which one do you think is easier to value on a relative basis? Mature company or growth company?
Mature.
Okay, let me ask you the same question, discounted cash flow value. Which one do you think is easier to value on discounted cash flow basis?
You can value.
It's going to be a mature company. The fact is, mature company is going to be easier to value no matter which approach you pick. Why? Because most of their assets are in the ground. You have far more information. The historical data is more relevant. That has nothing to do with discounted versus relative valuation. It comes from the fact that so much is uncertain in this company, and that's going to stay whether you use discounted or relative valuation. So that's not so much a discounted versus relative valuation. It's more of a life cycle issue of how much you know and how much you don't know. Okay. Yes?
and using that to develop valuation rather than, say, trying to refine a 10-year earnings estimate or
I think you're just exchanging one kind of uncertainty for another. Because the price at the end of the year has to reflect the uncertainty. The uncertainty doesn't go away, right? The fact that you've arbitrarily, artificially picked a 1-year time horizon doesn't mean the world comes to an end at the end of the year. So in June of last year or March of last year, if you did a 12-month forecast, you'd have estimated the price earnings ratios from March of that year, from last March, right? Which you'd have applied to the, even if your earnings were right to the cent, your price is going to be completely off, right? Why? Because the future has become a lot more uncertain. So when people say, well, I'm very confident about the earnings, they're looking at the wrong side of the equation. The uncertainty is not in the earnings number. You might be right. You know exactly what, it's in the price earnings ratio applied to those earnings, because that number will reflect all the uncertainty beyond year one. So that's what I meant about, you can either be explicit about dealing with what happens after year one, or implicit. When you say, I'm going to use 18 times earnings on my 1-year forecast, you are making implicit assumptions about what happens after year one. It's just in that 18 times earnings number. Okay. So we'll talk about this because there might be ways to try to bring in those assumptions more explicitly into that 18. Maybe there's a way to adjust that forward multiple. Okay. But for that, we have to do everything we did in discounted cash flow valuation, is to deal with what happens after year one. Okay. Any other questions? The last approach I'm going to kind of, for the moment, set on the table, but we'll come back to this in more detail, which is, and there's very little in valuation that's new and different. This is perhaps the only aspect of valuation where you can argue that new things are happening, which is applying option pricing models in the context of conventional valuation. Step back. Think about what makes an option. First, options are derivative assets, right? They derive their value from something else. So there's got to be an underlying asset. You can't have options are leeches. They can't survive on their own. So the first characteristic of an option is there is an underlying asset. Second, the payoff on an option is contingent on something happening, right? In a conventional call option, the stock price has to go above the strike price. And usually options have a finite life. You can't let an option run forever. So you have an underlying asset, you got a contingent payoff, you have a finite life. One of the things we're going to do when we get to the real options phase is we're going to look for assets. We're going to look at the cash flows, and we're going to look to see whether the cash flows are contingent on something happening to an underlying asset and whether they're timed. And if that is the case, we're going to argue that there is an option embedded in this asset and that we should be valuing it. Notice that I'm not going to be applying option pricing to value conventional options, or traditional options, and listed options. No, I'm going to be using options in unconventional places. And I'm going to be using a payoff diagram, because that's really the common characteristic that all options have, to determine when I should be using option pricing. Okay? So if you remember your payoff diagrams, what makes options different from every other asset is that limited loss feature, right? So in a call option, you got limited losses, unlimited profits this way. A put option, it goes the other way. Anytime you see an asset whose cash flows look like that, you got an option no matter what the asset is called. So as I said, I'm not interested in applying option pricing with conventional options because you get plenty of that in the other classes. In fact, I think a fixed income class is really an options class. Because if all you had was a straight bond, you'd be done in 15 minutes, right? It's the conversion feature, the call feature, all the special things that you add to a bond, and they all have option characteristics. So I'm not interested in valuing traditional options, listed options, warrants. Maybe warrants I might have to value, but only because I needed to value the equity in a company if it has a lot of management warrants. But I'm not interested in applying option pricing in conventional places. These things. So where are we going to apply it? We're going to look at least 4 places where I think option pricing is going to come into play. Here's the first one. You have stock in Ford or GM. Think about when you buy equity in a deeply troubled firm. Deeply troubled in the sense it's losing a lot of money, it has a lot of debt outstanding. You don't buy equity in these firms for the same reasons you buy equity elsewhere, right? Let's take the common reasons for buying equity and let's see if they apply to equity in a deeply troubled firm. You buying it for the dividends? I hope not, because you're not going to get any dividends. Are you buying it for the cash flows? Only if you like large negative cash flows, right? You're buying equity in a deeply troubled firm for the same reasons you buy deep out of the money options. Have any of you bought deep out of the money options? Sometimes you get greedy and you buy them. 2 weeks to expiration. the stock price is, way below the strike price. You buy it anyway. What are you hoping for? You're hoping that something good will happen, and you pray that something good will happen. Most of the time, nothing good happens, and the option ends up in the trash can, right? But once in a while, 2 days before the option is supposed to expire, the company comes out with this major news report that causes the stock price to double. Get ready for that call from the SEC. Have your ducks all lined up, say, no, this wasn't inside information. But when that happens, your quarter that you paid for the option becomes worth $5, and you've made, 15,000% return. Here's how it's going to matter. Some of you are going to pick trouble companies to value. You're going to find in a discounted cash flow world, these companies are worth nothing. On a relative valuation basis, the companies are worth nothing. You're going to be pretty desperate by the time you get to the real options phase. And I'm going to bail you out there. So you know what? This is an option. You've got to think of it as an option. Valued as an option, you can see why stock in deeply troubled companies will continue to trade even though the company is a basket case. Okay? So that's the first example. Second one, you're an oil company. Let's put a name, Petrobras. Those of you who have been tracking Petrobras for the last couple of years, they seem to find oil wherever they step. Oil here, oil there, oil there. Now 16,000. I don't even know whether this is true. They claim to have discovered all kinds of oil all over the place. But let's say it's true. You buy Petrobras stock. You're buying it for the traditional reasons, for the oil that they're producing. But the oil they're producing is actually a fairly small amount. You're actually paying the price for their reserves, right? These are undeveloped reserves. Petrobras can choose to develop these reserves. And remember, much of it is shale and it's under the ocean. Or it can choose not to develop these reserves. What will determine whether they choose to develop these reserves or not? Whether oil prices stay at $35 a barrel or $150 a barrel. There's your optionality. Undeveloped reserves at a commodity company take on the characteristics of an option. Which means value a commodity company, you can value the developed reserves as cash flows, but the undeveloped reserves are options. Let's say you're valuing a biotechnology company. A young biotechnology company. It has no revenues, negative earnings, huge costs. You say, why would I buy it? But it's got this really promising patent working its way through the FDA approval process. A drug to treat the flu. It's a magic drug. It might work out, it might not work out, but when you buy stock in the company, you're buying an option, right? An option hoping that this drug makes it through the approval process and provides these huge cash flows. There again, option pricing might come into play. And finally, if you're a company that is investing in China, and this is where we get onto dangerous ground. China or India are standard places where this argument is used. You know how it works, right? We're investing money there. We know we're losing money, but what's their fallback? Why is it okay? It's such a big market. We could expand the market, and their eyes kind of start to light up. Nokia will think, a billion Chinese with Nokias on it. That's a lot of people that we can sell products to. The option there is the option to expand into this huge market. You're saying, you know what? That option is so valuable that I'm willing to overlook all this money that I'm losing on this first investment. There are some companies, especially growth companies, which might have proprietary rights where you can say, hey, things go right. They could be the next Google, the next Microsoft. All cases where option pricing might allow you to come up with a value for a company that's more reasonable than a traditional valuation model. In fact, the biggest advantage of option pricing models is for these companies, those might be the only ways you can come up with reasonable values, because that's the reason you're buying the stock. As an option, valuing it as a traditional asset misses the point. It also is going to give you some insight into what drives the value. In fact, you probably remember enough about option pricing to help me on this one. What happens to the value of an option as risk goes up? The value of an option always goes up when risk goes up. It's the only asset class where risk is your ally, not your enemy. Every other asset class, risk goes up, value goes down. When you start thinking about an investment as an option, and I increase the risk of that investment, unlike traditional valuation, when you increase risk, value goes down. If you're buying an investment as an option, when risk goes up, the value will go up. That's an insight. Basically, what I'm saying is, if you're going to buy stock in a deeply troubled company, make sure it's a deeply troubled, risky company. You don't want to buy stock in a deeply troubled, stable company. What the heck does that give you, right? So you want risk to be your ally. You're so far underwater, you've got to kind of bounce back there, and risk is now your ally. So it is going to give you insight into what drives valuation. What are the disadvantages? You've got to value the option. You can't just talk about it. You need all the option pricing inputs. And one of the problems is traditional option pricing models were built for listed options on traded assets. We're stretching those models here to value things like patents. The underlying dynamics of the model start to break down. So when we apply these option pricing models, we've got to go in with open eyes. The numbers we're getting are going to be a lot more guidance numbers than actual numbers, because so many of the assumptions are violated. Here's the other thing to watch out for with options. You can very easily double count an asset. The way this works out, for instance, remember that biotech company that I just talked about? An analyst will sit down to value that company, project out really high revenues in future years because they have this pattern working through, come up with a value, and then add 80% to that value. We ask him, why do you do that? He said, well, there's an option in here. But he already built the option into the cash flows, into the growth rates. You can't double count an option. So we're going to come back and talk about how to avoid the double counting because it can contaminate your valuations. Any questions on the three approaches? Okay. If there are none, let's start on the first lecture note packet. Does the bookstore still have the packet, or are they out of the packet? Okay. Do you know? They're out? Okay. They're out of both packets, I think. Usually they'll get it in 3 or 4 days. So hopefully they should. So let's talk about the first. As I said, we're going to focus for the next 6, 7 sessions on the inputs that go into valuation. Yeah. I'm sorry?
Question on the,
sure, go ahead.
You talked about this last one, finance, hubris, and control, these things coming into the prices of say, any sort of asset.
Right.
Because I guess on the underlying sort of the supply and demand is sort of playing itself out, and then I guess the question is that at the end of the day, it's an issue of how much a person is paying for that specific asset, and those things come into it, or those important things to consider, and does that naturally sort of places relative value above, say, the intrinsic value because it doesn't?
Depends on the point in time. The question was about relative value being higher than intrinsic value. Don't fall into the trap of thinking relative value will always be higher than intrinsic value. Right now, for instance, the reverse is true. Because there are two things, right? One is hubris on one side. What's on the other side of the equation? Fear. And when you have crises, the fear factor essentially wipes out the hubris factor, and the same process that caused the relative value to be too high is going to push in the other direction. So it really is a question of timing. In some markets, the relative value will be higher than the discounted cash flow value. In other markets will be lower. Right? So it's a factor to keep in mind. You're saying, why should I care? It depends on your time horizon. If you have only a 1-month time horizon, you're stuck with this fear market. You can't say, I have an intrinsic value that's much higher, I'm going to buy the stock. It's not going to bail you out. You are stuck with what investors are bringing to the market. And that's why I said time horizon matters a great deal, and whether you go with one or the other. Right? Any other questions? Yeah. So I'm going to first, as I said, before I talk about the inputs, talk about how these inputs come into play. Discounted cash flow valuation, the value of an asset is the present value of the expected cash flows, right? So if I wrote it out as an equation, the value of an asset, you got I should have an expectation in front of those cash flows. So these are all future cash flows, discounted back to today using a discount rate. I'm going to state two basic propositions, and they're both pretty obvious, but I'm going to state them anyway because I think it's better to get them on the table. Take a look at that equation. Here's my first proposition. For an asset to have positive value, the cash flows have to be positive at some point in time, right? Mathematically, that has to be true. You think that's pretty stupid? Of course that's true. Here's another set of emails I get from people. I'm valuing a money-losing company. I expect it to keep losing money forever. What valuation model should I use to come up with a value for the company? To which your response is, duh. You're losing money. You expect to keep losing money forever. Why are you paying for this company? They should pay you to take the company off their hands, right?
The U.S. government.
Well, that's fine. Then they're using taxpayer money. Money doesn't come out of nowhere. I mean, so ultimately, somebody is always paying, even if it's being printed off the printing press. Here's the second proposition. If you're a company with negative cash flows up front, is that a bad thing to have negative cash flows? What kinds of companies have negative cash flows up front? One is, of course, GMs and the Fords, which are trouble companies. The other, of course, could be healthy companies, which are growth companies, where the cash flows are negative, not necessarily because they're losing money, but because they have so much in reinvestment needs. If you have negative cash flows up front, then you've got to have disproportionately large positive cash flows later on to make up for those negative cash flows. Why disproportionately large? If you lose $1 billion in year 1, why do you have to make $10 billion in year 10 to make up for it? Because that's a risk in the discounting effect. Which means if you're doing a growth company and you see those negative cash flows in year 1 and 2, don't freak out. That's okay. That's normal. But then pray and hope that when you get to that final year, the terminal value, that number is this huge number to make up for all those negative cash flows up front. So those are basic propositions. Might as well set them on the table. We'll come back and look at what kinds of companies it's going to apply to. So let's look at discounted cash flow valuation choices. I don't know whether you remember in corporate finance, we put up a financial balance sheet. A financial balance sheet. On the asset side, we have existing assets and growth assets. On the liability side, you have debt and equity. There are two ways you can approach valuation. They're embedded in that page. You can try to value the business, which is the asset side of the balance sheet. Or you can try to value just the equity in the business. Very different choices. I mean, I'll give you the analogy. Valuing the business is like asking, what's the value of your house? Valuing the equity of the business is asking a different question. How much is the equity that you have in your house worth? And for many of you, the answer will make you cry. Right? Because if you bought your house 2 years ago for $1 million and you borrowed $800,000, when you started the process, you had $200,000 in equity. Today, that same house has a value of $750,000. You still owe $800,000. Your equity is actually a negative number. But there are two different mindsets. If you decide to go the equity route, here's what you're going to do. You're going to take cash flows that equity investors get out of this business, and you're going to discount those cash flows back at a rate of return that equity investors demand for investing in that business. Let's take each side. Cash flow, so if it's a publicly traded company, you're equity investors, what's the only cash flow that you actually see from the company? What's the only check you actually get from the company? Dividends. Everything else is illusion, right? The dividend discount model is a special case of an equity valuation model where you look at what companies actually pay out and you discount those back at the rate of return you thought you would make when you bought the stock, right? In corporate finance, what do we call this? What is the rate of return that equity investors need to make? That's the cost of equity. Cash flows to equity discounted back at the cost of equity gives you the value of equity. In the strict view of the world, the cash flow to equity is dividends. Those of you in my corporate finance class, though, we did talk about actual dividends, which is what companies pay out, and potential dividends, which is what they could have paid out. In fact, how do we measure potential dividends? What was the measure that we came up with for potential dividends? We called it the free cash flow to equity, right? I know none of you remember how it was defined. But let's look intuitively at what we tried to do. We looked at how much cash was left in the till after you met every conceivable need. CapEx, working capital, debt payments. So that's a potential dividend. In a more expansive view of equity valuation, say rather than focus on what companies actually pay, which is the dividend, I'm going to focus on potential dividend, which could be a very different number. It could be a higher number in some cases, and this year actually it could be a much lower number. There are companies out there paying dividends where the free cash flows equity could be a negative number or a very low number. We're actually replacing what they're doing with what they should be doing. But they're both equity valuation approaches, cash flows to equity, discount the cost of equity. Here's the other way to do valuation. Rather than focus on just the equity portion of the business, you look at the entire business. Rather than look at the cash flows to equity investors, you look at the cash flows not just to equity investors, but to other claim holders in the firm. Debtors get interest and principal payments. That collective cash flow that everybody gets out of the firm is called the cash flow to the business, or the cash flow to the firm. If that is the cash flow you're discounting, your discount rate should be a weighted average of what equity investors want, which we said was the cost of equity, and what lenders demand for lending you money, which in corporate finance, what's the term? That's your cost of debt. The weighted average of those two numbers, in fact, is the cost of capital. Cash flows to the business, discounted back at the cost of capital, gives you the value of the entire business. Make up your mind early in evaluation what you're going to do. Going back and forth between these two gets people into trouble. So cash flows to equity, discounted the cost of equity gives you value of equity. Cash flows to firm, discounted the cost of capital gives the value of the business. Now, how many of you did valuation over the summer? Okay. Or on a previous lifetime? So I'll direct this question at you, and let's see if you can help me on this. It is true that I have a value of the business, but I'm still interested in the value of the equity, right? Because most of us can't buy a business. We can buy stock in the business, we can buy bonds in the business. So let's suppose we're still interested in the value of equity, but we have the value of the whole business. My question is actually a very mechanical one. You've done the valuation of the business, you're trying to get to the value of the equity. You're supposed to subtract out debt to get from the value of the fund. My question is, what is the debt you should be subtracting out to get to the value of equity? Okay? And I'll give you the choices. You can subtract out just long-term debt. You can subtract out all debt, all interest-bearing debt from the balance sheet. You can subtract out whatever debt you used as debt in your cost of capital computation. Or you can subtract out all liabilities, which would include accounts payable, supplier credit, all that stuff, which is not equity. Long-term debt, total debt, whatever you call debt in your cost of capital, are all liabilities. How many think it should be A? I've seen a lot of investment banking valuation where only long-term debt gets subtracted out. It's almost like the rest of the debt doesn't exist. The right answer actually is C. Once you've made your judgment up front, what you're going to call debt in your cost of capital, stick with it. Here's how it's going to manifest itself. When we do inputs to discounted cash flow valuation, I'm going to kind of insist that when you talk about debt for cost of capital, you should include the present value of leases as debt. You know what this is saying then, right? If you include the present value of leases as debt to compute cost of capital, once you value the firm, when you subtract out debt, make sure you subtract out that same present value of leases. So let's say you do this right. You value the firm, you subtract out the debt that you got in your cost of capital. You come up with the value of equity, right? Let's say you have a lot of time on your hands, you decide to value the equity directly in the same firm using cash flows to equity and cost of equity. Do you see what you do? You've got two valuations of equity. One by valuing the firm and subtracting our debt, and one by taking equity and valuing it directly. So here's my second question. It's again a pretty important question, I think, because it determines which approach you might use. Would you get the same value of equity using the two approaches, or will one approach give you a higher or lower value? What would you like? In a perfect world, what would you like? You'd like to get the same value, because think of the trouble you're going to be in if you put out a recommendation that says, I got to buy with an equity valuation model, but a sell with a firm valuation model. You'd like the numbers to converge. But try it out. Take a real company and see if you can match it up. In fact, I told you there are going to be weekly challenges. Your first weekly challenge this week. I'm going to give you a very simple company. I'm going to lay out all the inputs for you, so you're not having to make any judgments. I'm going to ask you to value the equity directly, then to value the firm and subtract our debt, and let's see if you get the same value of equity both ways. And when you get different numbers, as you will, I'm going to ask you, why did that happen? What is it about this process that gave you different numbers, when in theory, the numbers should be the same? In fact, to show you that in theory the numbers should be the same, I'm going to set up a very simplistic example. For the moment, just take the numbers in that example as kind of a given. I've kind of made them up. Okay? They're a very artificial example. It's one firm. It's 5-year time horizon. I've projected the cash flows to equity. So these are the cash flows to just the equity investors. I've also taken the interest expense net of taxes to add it back to get to cash flow of the firm. Remember, cash flow to the firm is equity cash flow plus debt cash flow. So you got cash flow to equity, cash flow to the firm. I tell you that the cost of equity for this firm is 13.625%, and that the pre-tax cost of debt is 10%. And I also add the fact that the firm has a tax rate of 50%. So after taxes, you're paying only 5%. So equity costs you 13.625%, debt costs you 5%. Finally, I give you the market value of equity and the market value of debt. Why do you need those? Because to get the cost of capital, you need weights, and the weights are supposed to be market value weights. Okay? So I got cash flows to equity, cash flows to firm. I can get the cost of capital, and I already have the cost of equity. Here are the two ways I can approach valuation. I can take cash flows to equity and discount them at the cost of equity, right? So I take the cash flows from the previous page, discount them back at the cost of equity. The value that I get for the equity is $1.073 billion. So that's equity, cash flows, equity cost, present value. I decide to value the firm. To get the value of the firm, I take a weighted average of the cost of equity and the cost of debt. I end up with 9.94% as my weighted average cost of capital, the weights being market value weights. I discount the cash flow to the firm back at the cost of capital. I get a value for the firm of $1.873 billion. But wait, that's the value of the whole business. To get to the value of the equity, I need to subtract out the debt, which is $800 million. Voila, I got the same answer for equity using that. Think of all the things that can go wrong here, right? In fact, on the next page, put a big X on the page, because if you, not this page, but the next page, because one of the biggest mistakes I see in valuation is people mixing and matching cash flows and discount rates. If you discount cash flows to equity at the cost of capital, you will get junk. If you take cash flows of the firm and discount them at the cost of equity, you will get junk again, because you've mismatched the cash flows and the discount rates. You think, how different can it be? I put a lot of work into the cash flows and the discount rates. Let's see how wrong you can be if you mismatch. So this is the page I want you to put a big X in, because when you're doing your quiz, you might be in a hurry, you might end up on this page and think this is the way you should be doing things. So say this is not the way you should be doing things. So these are mistakes that you can make in matching up cash flows and discount rates. If you discount cash flow to equity at the cost of capital, which is a no-no, right? Because cash flows are to equity, investments at the cost of capital. You get a value for the equity of 1.248 million, and you might conclude that the equity looks cheap because the market value is 1.073. If you take cash flow to the firm and discard the cost of equity to get the value of the firm, and then subtract our debt, well, equity looks like it's overvalued by 260 million, even though it's not. Once in a while, I've actually seen people get to this point and forget to subtract our debt, which I don't even know where to put that. You had the wrong cash flow, you discounted the wrong rate, you forgot a big element in your valuation, and you ended up with a value of equity, which is 1.613. You might not believe me when I say that this happens more often than you realize. In fact, when we start on Monday's session, I'm going to show you a page. Actually, I would send it to you before the class. It is from an actual acquisition valuation done in the late 70s by a well-known investment bank. Okay? I'm going to show you the cash flows, and I'm going to ask you to tell me what discount rate you'd use on those cash flows, and we'll talk about what they actually used. And you're going to see that this is a pattern that you see often in discounted cash flow valuation. Part of the reason for that is you have two teams. One works on the cash flows, the other works on the discount rates, and they don't meet till the last 30 minutes just before the deadline. So they all run in with their numbers. Nobody even stops and asks, what's your discount rate? Where did my cash flows come from? It's very easy to get mismatches on equity. We'll talk about consistency in general when it comes to discount rates, different currencies, different types of cash flows. But this is, I think, one of the first principles in valuation. Look at the perspective of who's getting the cash flows. Make sure your discount rate is estimated from that same perspective. Okay? We'll stop there. When we start on Monday, we will start with that example. Yes?
Good question, actually. Pretty